And welcome everyone to what is our third webinar and what we're planning to be a series of webinars to talk about the new marketing rule for investment advisors. And joining me today, we're very fortunate to have two excellent speakers. Mike McGrath from K&L Gates. Mike is a partner in the firm's Boston office and is a member of the firm's investment management practice group. And for those of you who have listened in on our past webinars, you know that Mike's done them so far, and so we welcome him back. And joining him today is Keith Marks, who's the Executive Director at Compliance Solution Strategies. Keith is responsible, he's manager of the firm's compliance consultants that provide services to advisors, among other firms, on a range of compliance and regulatory issues, including annual compliance program reviews, risk assessments, and doing on-site mock examinations. So we're very fortunate to have both of them here today. And Keith, especially you, I know you had to step in for your colleague, Matt Calabro, who was unable to participate today. So we really appreciate you stepping in and doing this on his behalf. So thank you very much.
Thanks for having me.
Sure, Megan, let's go to the agenda slide. So as you can see from this slide, we will focus our presentation on today's webinar on the marketing rules provisions relating to net performance requirements, including how you calculate net performance. And we will also talk about the new prescribed time period requirements, the 1, 5, and 10-year periods. And in connection with that, we'll also talk about the rules general prohibitions because they apply to all advertising under the new marketing rule. And so we certainly will talk about that as well. So we plan to spend about 45 minutes or so running through the materials that we plan to talk about. And we've set aside the remainder of the program to answer your questions, not only on the topics that we have here that we're ready to talk about, but also any questions that you may have regarding the marketing rule in general. So we look forward to receiving your questions. And if you could just type them into the chat box, and if I could ask that you please try to be short and concise. We have a lot of folks registered for today's call, today's presentation, and it'll just make it easier for us to sort of kind of go through the questions. So if possible, if you could try to be short and concise with your questions, we would appreciate that. We'll try to get through all your questions. Depending on how many we get, we may or may not, but we'll have plenty of time in the proceeding, in the following 18 months, which I do want to remind everyone, I guess before we move on, sort of where we are in terms of the compliance state. So the effective date for the marketing rule is May 4th. So we have exactly 2 weeks until firms can start to comply with the new marketing rule. It'll be followed by an 18-month transition period, and all advisors will be required to start complying with the rule on November 4th, 2022. And so that's sort of where we are in terms of the timeline. Next slide, Megan. Thank you. So this is the structure of the new marketing rule, and these are the provisions in what will be new Rule 2064-1. As you can see, the rule, as I said, has a set of general prohibitions, which we will talk about today. There are provisions on testimonials and endorsements, and third-party ratings, and there's a definitional section. As I said, today our focus will be on the performance section of the new rule. Next slide, please. So let's start our discussion with the general prohibitions that are at the beginning of the new rule. These prohibitions are applicable to all advertisements, and you need to sort of be mindful of them. One of the key is that every single one of these principles depend on the facts and circumstances of each communication, and that includes the nature of the audience that the marketing pieces are intended for. So under the first one, the advertisements may not include any untrue statements of material fact or omit to state any material fact. The second one is that if examiners show up to your door and they request that you substantiate any statements that you've made of material fact, that you're able to do so and that you have a reasonable basis. Materials cannot include any untrue or misleading implications or inferences. You have to provide fair and balanced disclosures and treatment of all material risk and material limitations. And with respect to references to specific investment advice, formerly known as past specific recommendations, you have to provide fair and balanced disclosures. And of particular relevance for our presentation today is that when you are presenting performance information, you must do so in a fair and balanced manner, including all related disclosures, which we'll talk about. Now, these principles should be very familiar to you. They've been put forth in various no action letters, SEC enforcement actions. They're based generally on the anti-fraud provisions of the Advisors Act. They're more specifically tailored to deal with marketing pieces. And there's a lot of discussion in the adopting release about these general prohibitions. And we'll sort of always keep these in mind as we sort of go through the various provisions. These are, as I said, principles-based. They do depend on the facts and circumstances. But the rule does, for the first time in an advertising rule for advisors, include provisions relating to performance advertising. Next slide. So the new rule includes these various provisions, obviously the new net performance requirements and the prescribed time periods, including how you calculate net performance. There's also a provision in there that prohibits you from making any statements about the SEC approving what's in your marketing pieces. There's somewhat detailed provisions relating to related performance and extracted performance. There's a definition of what is hypothetical performance and how you can present that type of material and that type of information. And there is a new section dealing with performance portability and sort of how, under what circumstances you can sort of take predecessor performance and bring it over to your new marketing pieces. As I said, we're going to focus our discussion today on net performance and the prescribed time periods. And so that will be the focus. Another thing I want to point out is that the SEC's proposed advertising rule had proposed requiring that you provide a schedule of fees, as well as a distinction between retail and non-retail or sophisticated investors, and those proposals did not make their way into the final rule. Those were eliminated. For our purposes today, for example, there is no requirement that you provide a schedule of fees. So that has been eliminated, and just wanted to highlight that. Next slide, please. So we'll go through what's on this slide throughout our presentation, but I just wanted to sort of start off by highlighting some of the key changes from the current advertising rule with respect to the content, as well as with respect to your policies and procedures that you'll need to plan for. With respect to the content of your marketing pieces, the new requirement that you provide net with gross performance, including in marketing pieces given to institutional investors, is a deviation that's sort of apart from the current no action guidance that allowed you to provide, gave you more flexibility when dealing with institutional clients. Under the new rule, net performance, anytime you provide gross, will be required in all marketing communications, including institutional communications. There is also a new 1, 5, and 10-year performance time period requirement that will apply to all marketing pieces, again, including to institutional clients. There is an exception for private funds, and we'll kind of go through these two in more detail. With respect to your policies and procedures, Keith's going to talk about sort of how you run through the net performance calculations, highlight some of the potential differences between how you do it now, and talk about some of the timing requirements about when you're required to provide the information by. Next slide.
Sanjay, before you move on, I think that it's important for us to note here that because we are focused on a couple aspects of the new performance standards under the rule, that we're highlighting those aspects. Across the entire rule, we've identified 8 or 9 different types of policies and procedures that are going to need to be updated. I also saw that we had our first question come in, and in a bit of an about face, I think I'll pose that one to you, Sanjay. The question here is, do all advertisements apply to ads about mutual funds as well, or are mutual fund ads governed by a different rule?
No, these only apply to RIA and mutual funds have their own rule in terms of how they do the marketing communication. So yeah, I see that we're getting some questions in the next slide. Should we move on? Great. All right, next slide. Okay, so this is the actual rule text in the new advertising rule dealing with the new net performance requirements. So as I said, anytime you provide gross performance, you're going to be required to also provide net performance. There's a prominence requirement in terms of how you present it, including the format, and as that's set forth in provision 1. And there's even a time period requirement and clarifying that you'll use the same methodology for both net and gross. So this is the rule text. You can refer back to it, but Keith and Mike are going to sort of walk us through various of these elements. Next slide. So this is the definition of gross performance that's in the new rule text. Gross performance means the performance results of a portfolio, which is defined to be a group of investments that are managed by an investment advisor. This can include an account of a private fund or portions of a portfolio that are included in extracted performance. This is something that the SEC put into the definition to clarify that performance results of a subset of investments are extracted from a portfolio are also subject to this definition. And the second part, before the deduction of all fees and expenses that a client or investor has paid or would have paid in connection with advisory services to the relevant portfolio. So this is the definition of gross performance. Next slide. And this is the actual definition of net performance. I'm not going to run through the actual definition now. As I said, Mike and Keith are going to sort of walk through these various provisions. We did highlight that sentence that's underlined, which is after the deduction of all fees and expenses that a client or investor has paid or would have paid in connection with an advisor's advisory services. That's our emphasis because I think that's a very key aspect of the definition. Next slide. Okay, so Keith, the new rule doesn't prescribe any particular method of how you should calculate net performance. It does provide what the commission refers to as a non-exhaustive list of the types of fees and expenses to be considered in calculating net performance. Can you sort of walk us through this slide and sort of how you calculate net performance, including the use of model fees?
Yeah, thanks. Yeah, we tried to put it into a bit of a picture here for everybody. And to start at the portfolio returns, it's to remember that this doesn't have to be a full set of your accounts. It can be extracted performance. It can be any part of performance that you're advertising, and you take it one step at a time from there. The important part about your policies and procedures as you go through all of this is to see that we're in an area here where the SEC specifically is saying in the new rule that the definition of net performance should be part of your disclosures to your clients because it is in fact a material piece of information related to any marketing of performance that you're going to do. So you're going to be more formal about this definition if you're not formal about it already. And you already have a definition in what you've constructed, and we'll see how well you follow along to what the SEC is recommending here essentially. So you take your portfolio returns, whatever they are, and there is an option that you can subtract transaction fees, trading commissions, but it's not necessarily the norm practice for anybody. I think if you were taking extracted performance, for example, and you wanted to show what the release, a commenter called pure gross returns, talking only very specifically about the investments, you might take that tact of reducing it by transaction fees. But moving past that is something that for most people shouldn't be an issue. We have our gross performance. And in order to go from our gross to our net performance, the SEC has given us these pieces to subtract advisory fees, including performance fees. That also applies to carried interest being considered in that category. And an underlying question that we can take and address in just a second is also whether that advisory fee applies to separate account manager fees that may be in the purview of the investment services that you provide. Also, fees paid to underlying investment vehicles are going to be largely embedded in what you're using already anyway. So unless you're making some effort to put them to do it otherwise, those are going to come out of the underlying investment vehicles underlying performance. And then fees in which the advisor otherwise receives reimbursement being the next piece of it, and expenses that a private fund may incur being a primary example of what you would be looking at in this situation. So those other investment expenses may need to be deducted as well in order to reach that net performance that is required under the new rule to always be delivered now, regardless of the sophistication of the investor. It has to be net performance. So let me back up for a second to a question we got earlier about deducting the advisory fees of separate account management. Mike, I'll throw that to you, and I'll let you summarize it, because I think you did well earlier, and I don't have it quite right in front of me in the chat box now.
Yeah, so Keith, we've actually received at least two, I think now 3 questions on really on the same issue. I'll read one of them here, but they're all varieties of the same question. Under the new rule, when a sub-advisor is making a marketing presentation to a wrap program sponsor only, with no clients present, must the materials the sub-advisor uses with that wrap sponsor include both net and gross performance? May these materials include a disclaimer on each page, such as for professional use only, not for public use or use with clients? There are a couple other varieties of this question. Another variety of the question asked when, in a similar situation, a manager is giving a presentation to an intermediary, whether it's a wrap sponsor or otherwise, and the advisor does not know what fees are charged by the intermediary to end clients. Does the advisor have an obligation to figure that out and include those fees in net performance? So let's think through this issue, because dealing with intermediaries has proven to be, really to continue to be, one of the more challenging aspects of this rule, and some of the language that the SEC gave in the adopting release does not make it easier. So first, let's answer one of the questions that was posed here, which is, does the manager need to show the wrap sponsor both gross and net performance in a one-on-one presentation to the wrap sponsor? I think the answer there is, if it is an advertisement, which is to say, if that presentation is used for anyone other than the wrap sponsor, someone in addition to the wrap sponsor, it becomes an advertisement, and every advertisement needs to show both gross and net performance. If, on the other hand, it is a presentation that was created only one time, directed to the wrap sponsor for the sole use of that wrap sponsor that one time, it is treated more like reporting or like correspondence, and this rule and the requirements in the rule do not apply. Chances are that's going to be a presentation or a format of a presentation that's used several times. So chances are you'll need to show both gross and net. The next element of these questions, may these materials include a disclaimer on each page, such as for professional use only, not for public use or use with clients? And Keith, you and I spoke about this a little bit. The question here, may these materials include a disclaimer? Well, of course, you can include whatever disclaimers you want on your materials. The question is, what's the right balance? Are you getting any actual benefits? And here, I think the answer is pretty clearly yes, that there are benefits to including a disclaimer along those lines. For professional use only, for investment professional use only, not for use with the public, not for distribution to third parties. And the reason is that, as we all know, the definition of an advertisement in the rule includes an indirect communication that is designed to offer advisory services. And there's some guidance in the adopting release that highlights situations like where a related person takes a communication from the manager and sends it out to third parties. That's an advertisement. Highlights situations like when a private fund advisor prepares materials, delivers those materials to a third-party feeder, like a bank feeder, And that third-party feeders manager then sends those materials out to investors in the feeder fund. According to the guidance in the release, those materials are advertisements of the underlying manager. And the crux of the matter there is that any materials that are given to an intermediary for the purpose of distribution onto third parties will be deemed advertisements of the manager. But in this scenario, it sounds like what we really have is a manager seeking to make a presentation to the intermediary, not contemplating that those materials would be sent on to third party or end investors. And in that scenario, you want to do something to demonstrate that the person receiving those materials is not authorized to redistribute them. Because we also have guidance that says that if the intermediary acts beyond the scope of their authority, or they make changes to materials that aren't approved, that the advisor would not be responsible for the content of those materials in that scenario. So marking the materials, I don't know that it needs to be on every page, but it can't hurt, with an indication that the materials are confidential and not for distribution to third parties, is a good way to demonstrate on the record and in the records that you have that the intermediaries are not authorized to distribute those materials on. And they won't be deemed advertisements delivered to the underlying clients in that scenario, unless of course you happen to be giving a wink and a nudge and looking the other way when you actually know that those materials are sent on. So under the totality of the circumstances, if you tell the intermediary not to send them on and you don't essentially allow it through looking the other way, then they won't be deemed advertisements, even if the intermediary acts beyond the scope of his authority. Now, one more point, and finally coming all the way back around to the person who asked, does the net performance need to reflect the performance of the intermediary? Well, in a scenario where you've not authorized the intermediary to send the advertisement on to third parties, then I would say that the answer is no. It should be performance net of the manager's fees, and the intermediary will judge that performance based on the way that it sees them.
Thank you, Mike. So we have a couple of other questions here that let's just go ahead and hit. So one question is, do you have to show net performance or both gross and net? Keith, you want to respond to that?
Just net is fine. The rule is if that you want to show, the rule is really saying if you want to show gross, you also have to show net. But you can just start off with net.
Right. And Mike, how about this one? If we discuss the performance of a sub-advisor, private fund, or specific investment, do we have to present the performance net or our own hypothetical advisory fees?
It's probably
That's a fantastic question, and a question about which we will spend a lot of time in about 15 minutes. So I suggest that we put a pin in that one because it's one that we're going to have to really think through as an industry.
Great. Okay.
So we can hit the next slide. And we'll get a little more guidance about some of the things that we're talking about, and some clarity about one particular issue, that custodian fees, they do not have to be included within the expenses that you're deducting to reach net performance, even when the advisor recommends the custodian. However, in a wrap fee context where everything is bundled together, the SEC makes clear in the release that you should include all the fees included in the wrap fee program when you're the sponsor of it, for example. So there's actually a little bit more guidance to the question we were talking about in some context there, Mike and Sanjay as well, about things that have to be included. There's other context in the rule release that talks about private fund managers would include admin fees in deducting them from their net of fee calculations when those admin fees are part of the bundle of the IA fees. They said there's no per se rule about whether admin fees actually have to be part of the deduction of expenses, and you end up with the fact of you're handling with disclosure whether or not you are doing that. If you are going to separate those admin fees in some way, you're going to need to really handle that with disclosure based on that guidance, and clearly a push by the SEC to say if you're putting them all together into a single fee, you're making those other expenses in connection with your advisory fees in a way that you otherwise are not when you do not bundle the fees to the customer. Okay. And capital gains taxes is another thing that they made clear that, it's really not part of this condition of determining net performance. Capital gains tax is going to be different in different circumstances for different people, and it doesn't have, and the tax rate may change for that matter, that you'd have to, there's so many variables to what that would be that it's disconnected from the advisor's performance and does not have to be reflected in any figuring out of what net performance is. Okay, next slide. So they have not eliminated the practice in which you can substitute for actual fees a model fee. And they've essentially followed what I understood to be the guidance under Clover Capital in providing their answers here, that you're going to use a model fee that is higher than that's the highest actual fee that would be deducted to the intended audience. So whether it's the actual one or the one that would be charged to the intended audience because it's prospects, you really have two options here. You can create a net performance number using a model fee that is the highest fee for all the returns that would be subjected to that model fee, or you can have a process to identify the intended audience and get a more specific model fee that would be the highest fee charged to that particular intended audience. So you can break it down. And I think that this is an area where you may have to implement some policies about we will only use this model fee, which is not our highest fee, when we have clearly classified the prospect as part of an intended audience that would get that fee lower than our overall highest fee, but the highest fee that we would ever charge that person. So that's going to require that's some very detailed record keeping that you're subjecting yourself to if you want to start to parse it that way. The high level way is to still just say, I'm going to take my overall highest fee that applies to this investment strategy and deduct it from everything. Later on in my conversation with the prospect, and when I learn more about that prospect and what fee level they might fit with us, I might give them a further update that shows the impact of their lower fee on our performance. So some pieces and things to think about there as this has sort of been pulled apart. Like they're really similar concepts to what we had before, and they've all been subjected to more critical thinking. So the idea that I was just talking about is elaborated on in respect to how it applies to private funds within the rule release, talking about multiple series of classes of funds with different fees, and until you know where the investor would fit within your series or classes that have different fees, you have to give them the highest fee. Once you know where they might fit, you can give them the fee that would apply to them as the intended audience. So
Keith, one thing I want to point out real quickly on this this development, the addition of the ability to use a model fee that is equal to the highest fee charged to the intended audience, is that prior to the release of the 2020 GIPS standards, GIPS did permit the use of a model fee according to this standard, the highest fee to the intended audience. And with the release of the 2020 GIPS standards, which happened right about a little bit in advance, but roughly around the same time that the proposed rule came out, the CFA Institute restricted the use of model fees a little bit more than what they were under the 2010 standards, to use what we'll call the old Clover Capital or the traditional SEC view. Meanwhile, the SEC adopted the slightly more permissive view of allowing the model fee based on the highest fee charged to the intended audience, whereas previously the SEC had taken the position, at least in public no action relief, that the model fee would have to be a model fee that was essentially equal to the no higher than if the actual fee had been deducted. So there was a little bit of a flip-flop there, although when you think through the consequences, it's not as bad as it might seem at first, because although GIPS reports themselves will need to be calculated based on a fee that produces performance no higher than if the actual fee had been deducted, GIPS does permit in the use of supplemental information, which we would consider to be most of the presentation that has a GIPS report attached to it, the calculation of net performance according to other standards, including the one that we see here. So it's a bit of an unfortunate inconsistency between GIPS and the new rule, but there's guidance from the Institute that goes a very long way to reconcile the two.
Yeah, it's all interesting, and just having these conversations, hearing your answer before about intermediaries, takes me back to the reality of drafting policies and procedures that are updated based on these things, and then reviewing them with management and the submitters of marketing materials across your company, the people in your marketing department, and trying to come to a consensus with them about how it is you want to handle an issue like the deduction of a model fee, if that's part of your business, right? And giving them those options, right? And seeing where you come down as far as how your firm's going to handle it without the most operational difficulty, right? Or something that's not just so painful. And we used to come to the answer that some people may come to as well, which is, what we're going to do gross performance, we're going to do net of the highest fee, and then if we think we know what this investor will be, we'll use another fee level in between it, and just start to show multiple options. So there's a lot of potentially complicating features, and so picture yourself, if you're in the audience right now, the conversations you're going to be having with people in your firm under your new policy about where you land on issues like this, and how you might be drawing maps on a whiteboard about what this all means. So sorry, I diverge a little bit. Kind of takes us over into the next slide as well, though, about potential disclosures.
Actually, Keith, before we move on, there's a question here, and I'm just going to pose it as written. If custodial fees are paid by the fund, do they always have to be included in net calculation? If not, which cases involve payment by client?
If custodial fees are paid by the fund, do they always have to be included in that calculation? I think the answer for that we just read is no, they don't always have to be included in net calculation. If not, which cases involve payment by client, and when the client's paying the custodial fee, that's a good example of why we don't go down this route. The custodial fees could be paid separately, and I think the SEC didn't want to make a rule here, like they said in many circumstances. They really, in doing this rulemaking, consistently cited the diversity of the industry and how it does business. And custodial fees is another example of different ways that people do business. And so they did not want them to have to be included in performance. If you're asking me a RIC question about them being included in the fund calculation, that's different. You back over the Investment Company Act like we did with the earlier question. So hopefully I'm taking that right.
So along your point, there are sort of different custodial arrangements, and Mike, there's a discussion in the release about situations where you may have to include custodial fees. Do you want to maybe elaborate?
Yeah, Keith had flagged this previously, and I'm having a little bit of trouble understanding the question the way that it was posed. But the key thing to understand here is, in a situation where the advertising advisor has also contracted either directly or through its affiliates to provide custodial services or other services, when those services are coming from the advisor, then the fees for those services need to be included in the net performance. And there are a couple reasons, if you stop and think for a bit, about why that that would be the standard. We can intuit why the commission, advised by the staff, would implement that standard. Number one, we need that in order to make a meaningful net performance calculation for wrap accounts. But also, we don't want to be in a situation where an advisor could take the position that it is providing investment advice for 1 basis point, but also agree contractually to provide a custodial and potentially administrative support for 80 basis points. That would be an opportunity in some ways to circumvent an appropriate net performance calculation. The rule requires that you take a net performance stream calculated at 81 basis points under those circumstances. And for institutional investment managers, this likely will not be a big concern because they typically do not have assets custodied. Their clients typically don't have assets custodied at their affiliates, and it's very uncommon for an institutional client to seek to pay an aggregated fee to a manager for both custodial and advisory services.
Thanks, Mike. So Keith, there is a good discussion in the release about the types of disclosures that you would be expected to provide. You want to maybe start us off on this discussion?
Well, sure. And one of the interesting things about the list of potential disclosures that are here and taken from the release is that this list of potential disclosures is included at the end of the net performance discussion in the rule release, but it references back to the general prohibition about having fair and balanced performance marketing. And the first bullet here described the type of performance return presented is really what we've been focused on. Is it net, is it gross, how is it defined? And understanding that the SEC wants disclosures that talk about, how you've calculated the performance. Let the reader understand what it is. And it goes to some other issues where we've been talking about that they didn't mandate the actual calculation methodologies in any way. They only mandated certain parts that they thought needed to be done to make it not misleading, primarily the deduction of advisory fees. And they left very much open what the actual type of performance return being presented is. That is, what's the actual calculation methodology? Are cash flows impacting the way that the advisor is calculating performance? The treatment of transaction costs is something we discussed about whether it's in there. Is the advisor using the Dietz methodology? Is it an internal rate of return of a private equity fund? Are they equal weighted returns that may be being used? The IC Act provides a comparison of a more prescriptive approach that's used for money market funds. They say calculate performance this way for a money market fund. That's not what's being done here. They're not telling advisors which methodology to use. And the reason for that is because private equity firms are managing off of the J curve, and they use internal rates of return versus advisors that might otherwise more traditionally use just standard time weighted returns. So all that's part of it. It should all be part of your procedures, just in talking about defining what it is your performance results actually are, so that you have upfront policies and procedures about that map, the back end supporting calculations that are being done. Larger institutions that are listening will be saying, yeah, we have really documented a lot of our processes already, and we'll be amending our policies to meet some of these new definitions and pieces along the way. Other firms that might not be so accustomed to documenting descriptions of the performance return presented and the characteristics of how they're calculating their performance, rather than just having the spreadsheets that do it, we'll need to take some time probably under this new rule and accept from this guidance that it's asking you to document more of this so that you can substantiate it upon demand to the regulator when they come about what's happening in order to tie into another piece of the general prohibitions, right? So the rest of the potential disclosures here are more about, the portfolio itself and not the performance calculation, but what the who, what, why, where, and when of what the advertising piece actually is with respect to performance. The adopting release makes very specific reference back to examples provided in the proposing release, footnotes 190 to 195, that talks about specific examples of how you would write disclosure to address particular market conditions or particular characteristics of investment strategies that could result in you having additional disclosures. My favorite learning compliance was the Van Kampen case about IPOs and the fact that their advertising was considered misleading by the SEC because the early IPO gains that they have could never have been replicated, and they should have disclosed to clients that those early returns were exceptional and part of a IPO frenzy in the market that they were able to get into, and it wouldn't be repeated. And those are the kinds of things that take introspection, very much so, amongst your strategies, and work through documentation about what are the actual conditions, objectives, and investment strategies, and what's leading to the investment results that we have. So on an ongoing basis, are the investment results that we're getting somehow impacted by material market or economic conditions? Is there something we should disclose about that? And then the SEC throws in the possibility of loss. They haven't even mandated language any longer to say, what the specific language should be. Past performance is no guarantee of future results. And the final one, material facts relevant to a comparison to a benchmark, being fairly consistent, I think, with the practices that we engage in primarily, which is providing a benchmark and explaining the benchmark, and any material differences that you could, not to the nth degree in that disclosure, and that part certainly becomes more art than science, and I think that'll continue of, how detailed do you get in making those distinctions with a benchmark in your disclosures. So there's a quick overview of that. I know we still have a lot more for Mike to go through here about prescribed time periods.
Before we move on, Mike,
can be delivered.
Sure, Mike. Before we move on, Mike, I know there's a couple of questions in here about sort of disclosure, location of disclosure. Do you want to just hit those?
Yeah, sure. There was I'll read the question here. Your slide 14, that is a lot of text. And I think she's talking here about the disclosure that is necessary, Keith, not your slide.
Yeah.
Is that all supposed to be on the same slide as your gross and net performance? Or can you say C notes and put them in the back? You can say C notes and put them in the back. There are very, very few disclosures under the rule that expressly need to be presented either with equal prominence or in a prominent fashion. If you see that word prominent in the rule, that means you need to have it on the page. And that's, for example, the material disclosures with respect to testimonials and endorsements, which we're not going to talk a lot about today. That's a prominent disclosure requirement. It needs to be on the page. But outside of those prominence requirements, and in particular with respect to performance, your disclosures need to be fair and balanced. And what that means is at each quote level or each point of presentation, you need to have a balanced amount of disclosure compared to what's on the page. So if your performance on the page suggests that an investor is going to make a lot of money, it probably would be prudent on that page to say past performance is not a guarantee of future results, and investors could also suffer losses. And then say, see additional notes, and take all of this other information and move it to the back of the presentation. And this concept of layering disclosure is something that people have done. When I say people, I mean registrants have done to varying degrees over time. And it is discussed in the rule release. It is permitted, but it's not permitted with an absolute, not permitted absolutely in all cases. There needs to be a balance of disclosure on the page, disclosure in the back of the book, and it's always prudent to note to the reader where they can see more information.
Okay, Mike, I'm looking at the clock here. Let's table the other questions to the end.
Okay.
I do want to just clarify one thing. We're getting some questions along this line. These are the list of considerations, things that you should be thinking about whether they apply to your particular facts and circumstances. So these aren't, the SEC is not mandating any specific disclosures you have to make, but they're giving sort of some things to think about here and whether they apply to your particular marketing piece. And so these are potential disclosures that you want to consider. So this is not a list of things that you have to address in your marketing piece. Megan, next slide, please. Okay, so we're going to switch gears here. I'm going to talk about the new requirement that you provide 1, 5, and 10-year periods. And later Mike's going to talk about sort of this notion of equal prominence and sort of what that means. Before I turn it over to Mike to run through this, I'll just kind of highlight that this requirement does not apply to marketing pieces directed at private fund investors. This is something that the IAA had asked for in our comment letter, so we were very pleased to see that built into it here. So Mike, do you want to sort of walk us through this element of the new rule?
Sanjay, let's clarify. The IAA had asked that this not apply to private funds, and we're very happy that it doesn't.
Right, sorry.
Yeah. Okay, next slide, please, Megan. All right, so this new requirement, what does it, what are the elements of the requirement? An advertisement that includes performance must include performance across 1, 5, and 10-year periods. And then we say, or since inception as applicable. We had a question earlier today, what if I don't have 10 years of performance in a strategy? If you have 7 years, then you will be presenting 1, 5, and 7. If you have 3 years, you will be presenting 1 and 3. We also sometimes get questions, what if I want to use other periods? What if I want to present 1, 3, 5, 7, 10, and inception? That is also fine as long as you present 1, 5, and 10. Each of the periods, the 1, 5, and 10-year periods, must be presented with equal prominence as of the most recent calendar year end, or a more recent date if you are electing to show a more recent date. And as Sanjay pointed out, this is not applicable to private fund performance. Now, if you're reading very closely and very carefully here, you will see that there are some differences between the prominence requirement of this 1, 5, and 10 year performance requirement on the one hand, and the gross and net performance on the other. Next slide, please. In this case, the obligation is that the advertisement, and the advertisement in this case might be a flip book, it might be a web page, might be an email. The advertisement must, quote, include the 1, 5, and 10-year periods of the same portfolio or composite that is being presented or that is being offered in the advertisement. And there needs to be equal prominence among the 1, 5, and 10-year periods, but there's no express requirement that the 1, 5, and 10-year periods be equally prominent to other expressions of performance. And what this means, at least in theory, and I'm not suggesting that everybody go out and do this, this means at least in theory that a firm could show, have a prominent presentation of gross and net performance on an inception to date basis, and then also include somewhere in the advertisement 1, 5, and 10-year performance. Now, that's good news. It means that we have more degrees of freedom as to how we're going to satisfy this obligation, but we need to be very careful because, as Sanjay pointed out 45 minutes ago, all performance information needs to be presented in a fair and balanced manner. And so if a firm has exceptional performance over the most recent quarter and highlights that, or has great performance back in the 80s and 90s, so highlights its inception to date performance, but the performance is not as good over the 10 more recent years, then diminishing the prominence of these 1, 5, and 10-year periods would be a very good way to show that you're not presenting performance on a fair and balanced basis. So while it doesn't need to be absolute equal prominence between the 1, 5, and 10-year performance or any other performance that you show, what's very good to pay attention to here is that the only obligation is to include 1, 5, and 10-year, not to ensure that 1, 5, and 10-year is presented with equal prominence to any other performance expression that you show. Next slide, please. Now, what I've just introduced is actually, I think, a very important point, and it's one that we got a couple questions on that I'm going to try to field here, which is when we're thinking about prominence and equal prominence or inclusion or equal prominence among 1, 5, and 10, but not among others, how do we navigate that? What do they mean in practice? Because I know that for those of you who are in-house attorneys or compliance officers, if you haven't received this question yet from your marketing and sales teams, you will shortly. And it's an intriguing question and unfortunately one that we don't have a straight answer for just yet. Next slide, please. So let's think first about the distinction or the difference between the presentation of gross and net performance on the one hand and 1, 5, and 10-year performance on the other. If you present gross performance, and performance is defined in a very, very broad manner to capture any expression of the manager's performance or hypothetical performance. If you present gross performance, you must, according to the rule, must, with equal prominence and in a format designed to facilitate comparison, present net performance. The net performance needs to be calculated over the same time period, using the same type of return and the same type of methodology. Now that's different from what I was just talking about with respect to the 1, 5, and 10-year performance. And when we stop to think about what this means, and if we go to the next slide, it could mean some very different things depending on how we interpret it. Next slide, please, Megan. A strict reading of the rule means that every time you show any performance expression, you must have net performance on the same page with equal prominence every time that you show it. And while that might make sense for most expressions of performance, like a 1, 5, and 10 or an inception to date number, it becomes very challenging to implement when you think about risk metrics, R-squared, Sharpe ratio, and attribution, all of which are more commonly derived from gross performance rather than from net performance. And from a mathematical perspective, it can be very, I don't know that I would say difficult, but you have to make some assumptions if you're trying to derive attribution from net performance. It doesn't really make sense. Nevertheless, if we have a very strict reading of the language of the rule, that's what it seems to require, that if you want to show attribution over the last year, you have to, and you would typically do that in gross, you now have to do it in net or do it with gross and net in equal prominence. And I offer that my personal view is that I don't think that makes a lot of sense. Now, by contrast, if we interpret this rule based on the totality of the communication, then it may be sufficient to compare gross and net performance one time prominently at the front of a presentation, and then present risk metrics and attribution based on gross performance in subsequent pages. And that doesn't seem to violate the spirit of the rule, but it's not entirely clear that that's acceptable. Another example here, and although we recognize that the 1, 5, and 10 requirement does not apply to private funds, the gross and net requirement does. So it's very common for private equity managers to present their portfolio holdings in the form of a table where you'll see the dozen or so portfolio holdings demonstrate their performance, each on a gross basis. And then at the bottom of the table, the sum, or I guess the product of that performance is going to be the gross fund level performance followed by the net fund level performance. Well, this is common. This doesn't seem to be misleading, but a straight reading of the rule would seem to suggest that a model net performance needs to be calculated for each of the individual holdings. And again, I would submit that that doesn't make a lot of sense, particularly for funds that charge carry on a portfolio basis rather than a position by position basis. Any model that's used to express performance on that position by position basis is not going to be very meaningful. So this is an area where we have an open question. And it will not surprise me, and I don't want to put any words in Sanjay's mouth, if the IAA didn't facilitate a good way of asking this question: just how is the performance requirement related to gross and net supposed to be interpreted? And are these examples that I'm using with a presentation on a page that shows gross and net on a portfolio basis, but only gross performance on a position by position basis, or for the institutional managers where attribution and risk metrics are calculated off of gross performance? Are those things acceptable if net performance is presented in a prominent manner early in the advertisement? Right now, I could not advise clients that is permissible, but ideally within the next 18 months, we'll get to a point where we get some guidance from the staff adopting something like that position, I would hope.
You love to put words in my mouth, but I think you're right. We've been, and you've been part of those discussions. I've been talking about these issues with our members, and we'll talk more about that in terms of how members on this call can get involved. Mike, so we do have a couple of questions before we sort of move on to our key takeaways. Let's start with the question regarding related performance or composite advertising. Do the 1, 5, and 10-year periods need to include any and all accounts managed during that time period to avoid cherry picking concerns? In other words, accounts that terminated along the way or that entered after start of the period header, or can it include only those accounts managed for the entirety of each of the 1, 5, and 10-year periods?
Well, that's a great question. As many on the call know, GIPS requires that you include all of the accounts that if you're showing composite performance, first of all, if you're showing composite performance, GIPS requires that it includes all of the accounts across the entire time period. My interpretation of the related performance definition and requirements in the new marketing rule, which we didn't talk about at length, is that it does not expressly require the GIPS standards for composite inclusion, but it does in the adopting release make reference to those standards as one way, consider it a non-exclusive safe harbor for deciding which accounts should be in and which should be out. My recommendation would be to start from the assumption that the SEC does not want to promote survivorship bias, and that if you were to exclude accounts that had closed over that period of time, then in order to satisfy the obligations of the rule, you would need to come to a conclusion first that practice did not result in you having materially better performance than you would if you had included all of the accounts over time, including the ones that closed.
I agree. If you took that policy, you're subjecting yourself to the regulators doing a calculation to see if your exclusion of those accounts that were only there for a partial period of time changed your account performance in such a way that it benefits you. And anytime that it benefits you, they're gonna, I think, according to the rule of the definition of related performance, say that you have violated that part of the rule. It's sort of an ipso facto, right? If you're going to exclude related accounts and the performance is higher because of it, it seems exactly to be what the SEC is discouraging.
Yeah.
We're getting some questions relating to hypothetical performance and sort of how these 1, 5, and 10 requirements apply. Do you want to just maybe address that and clarify?
Yeah. This is that's a very astute question. The requirements related to hypothetical performance are onerous. They require an assessment of the sophistication of the recipients of the performance. That's going to require either some knowledge about who they are or some knowledge about their sophistication based on thresholds that we're accustomed to, like whether they are qualified purchasers, perhaps very sophisticated QIBs, or similar thresholds. Now, but the question here is, do the 1, 5, and 10-year requirements relate to hypothetical performance? And the answer is the requirements with respect to hypothetical performance expressly exclude some other requirements in the rule, and the requirement as to 1, 5, and 10-year performance presentation is one of those that is excluded. They also exclude the requirements as to related performance that we were just discussing.
Talking about hypothetical, you mentioned making an assessment of whether the investors have the resources or the financial expertise. And the question here is with respect to whether this would essentially just preclude robo-advisor investors from getting this information. Can you just talk about that and just more generally sort of what the commission was intending here to do, particularly with respect to individual and retail type investors?
Yeah, so I'll start by saying I don't think this necessarily precludes robo-advisors from presenting hypothetical performance information in all cases. The commission went to pains in the adopting release to highlight the point that different types of hypothetical performance information introduce different levels of risk, such that you should consider it as being a gradient of sophistication. And depending on the type of information that you're using, you might need to do more to assess the sophistication of the recipient audience. So in the rule, projected or target performance information is considered to be hypothetical performance information. But in the release, the commission notes that that's the type of hypothetical performance information that introduces a lower risk and consequently wouldn't necessarily have to have the same degree of sophistication within the recipient audience as compared to something like back-tested performance information, which introduces a high risk of a variety of biases and of the audience being misled by that information. Now, in some cases, a firm can rely on, as I said, dollar thresholds as a proxy for sophistication. Other recommendations made in the release included knowledge that certain investors have invested in certain types of funds historically, and that could be used as an indication of both their sophistication and the relevance of the hypothetical performance information that is being used. So coming back around to the example for the robo-advisor, if the robo-advisor is collecting valid information, regarding the interests of the prospective investor or client, and regarding the net worth of the prospective investor or client. Sometimes I see these looking for information regarding the years of experience investing that the client has. Then I think that an advisor could establish a policy and procedure that establishes certain thresholds to show different types of information. And in my view is that the threshold for projected or really target performance is probably pretty low, as long as you have a policy and follow the policy to show that it's only going to certain people. I should wrap up by noting what I don't think is acceptable under this rule is the presentation of hypothetical performance on a website that is not subject to a firewall, because there's no way of implementing a policy to control who sees it.
So we've been getting some questions regarding the 1, 5, and 10-year and the requirement that it be provided as of the most recent calendar year. There was a recent SEC FAQ. I don't know if, I'm sorry if you already addressed this, Mike. I was reading all the questions, but do you want to maybe just clarify sort of the timing requirements along those lines?
Yeah, I haven't addressed this yet. This is actually, this is fairly troublesome. So the requirement is to show the 1, 5, and 10-year performance as of a recent date that is no older than or no more dated than the most recent calendar year end. And if you think through that, it can really make marketing with the use of performance challenging in the first couple months of the year, or even the first couple weeks of January. Particularly for certain types of advisors that rely on or that require underlying valuations from the assets that they invest in, right? The 1, 5, and 10-year rule does not apply to private funds, But if you have a separate account that in turn is invested in private funds, it could be months before you get values for those funds. In response to a request for guidance, the staff published, I think it was last week, a statement that said the staff would not recommend enforcement against an advisor that that used performance that's that's older, or as of a date older than the most recent year end, as long as it was generally no longer than a month, which means that apparently if you now have 1 month, if you are offering advisory services rather than private fund interests, you have 1 month to calculate performance, unless a person wants to take a more permissive read of the use of the word generally in that guidance. I find it to be somewhat challenging, particularly for advisors that are not in the habit and don't want to be in the habit of calculating and presenting preliminary performance results that then need to be corrected or updated. And I think that's a real risk based on that 1 month time frame.
Great. Just remind folks, we have a few minutes left. Please enter your questions in to the chat box, and Mike and Keith would be happy to discuss them. Keith, I just threw you a question in the chat box. Can you address that one?
Sure. The question was, can we discuss the performance of a sub-advisor, private fund, or specific investment with a client? When we do that, do we have to present that performance net of our own hypothetical advisory fees? And I think the context of this, I read, is that you're talking about a potential investment, you're talking about a potential strategy with a customer, and you're not actually presenting your advisory services, performance information in doing so. So the answer would be no, you don't have to show that net of your own hypothetical advisory fee. That would be very cumbersome to try to review a specific investment with a client and try to also have to deduct your own fee. So no, I don't think you have to do that.
And Keith, someone is asking if you could clarify when you discussed about private funds and the interest payment calculations.
But the interest payment calculations, I'm not sure maybe that came off as something. I think it was about carried interest was the closest I said to that, which is carried interest is part of advisory fees, and along with other types of performance fees need to be deducted in order to reach net performance.
Mike, this one's for you. Is performance of a model delivery program or other non-discretionary advice provided in real time considered hypothetical performance?
So that's a great question. Did that come from someone on the IAA marketing group there, Sanjay? Because as Sanjay knows well, the IAA in its comment letter to the proposed rule suggested that models that are delivered to clients for compensation should be treated differently from models that are internally at the advisor, and that models delivered for compensation, which is the case in this model delivery program, really should not be considered model portfolios and consequently hypothetical performance. Now, I think that issue remains unclear. Number one. Number two, I do think that an advisor that's presenting real-time performance based on models, provided that they are the models that are delivered for compensation, that entered into, that put together policies and procedures describing the models that it would use, and it would only use models that reflect the actual delivery of investment advice, could take a good faith reading of the rules to conclude that that's not hypothetical performance information. But it's another area that is ripe for further staff guidance.
I think I would be thinking about writing down the rules, Mike, around the pricing of the securities within the model. Am I tracking it? But to make it real performance, am I tracking it as a matter of policy of the prices of those securities at the end of the day, for example? Or am I tracking it at a designated time that the investment decision was made internally, and then I've got to keep records of that? But there's issues like that that are going to come up in
And
doing.
this is the reason, yeah, this is one of the reasons that a lot of model delivery providers manage I guess I could call it a shadow account, but it's a real account, manage a real live dollar account according to the models that they deliver, for essentially for the sole purpose of establishing and maintaining this performance track record.
Yeah.
So we've got a couple of questions here, but I do want to make sure the audience gets the benefit of sort of your key takeaways here. Keith, you want to maybe start us off on that?
Yeah, absolutely. So we've talked a lot about the first bullet here, which is to implement documented procedures to describe the methodology used to calculate gross and net performance.
Megan, let's go to the next slide while we do this.
All right, yeah, there you go. So the first bullet point about documenting procedures, describing the methodology to use to calculate gross and net performance. You know, what we have is attention in the rule now to these definitions. The attention in the form of those definitions drive us to make these definitions part of our procedures and to make sure that we have more controls across these issues than we had previously. Keeping accurate records of performance calculations, you know, there's an extension to additional types of advertisements under the rule. You should now be thinking about starting to develop communication and training plans for the content creators, taking these bits and pieces that the IAA is doing a great job of delivering in the series of webinars, and highlights all of the very specific issues that need to be communicated about what can and cannot be done going forward. And the more clearly that you can communicate that to the content creators, the less you'll have to do on the back end. So, you know, it's one of the, we encourage compliance people to think about that in terms of do your homework, get these things into policy and educate so that the back end is better, so that you can point people back to the training again and correct it as you go through the processes. Everybody's going to have to take all of their existing materials and put them through these prisms and lenses that we're now getting from these different presentations, and continue to investigate and do due diligence and meet with team members to make sure that there are disclosures about the relevant facts of portfolios and the performance advertising, so that they are fair and balanced across the presentations. And that has to do with considering a lot of the context that Mike, you've been doing a great job describing, and Sanjay, that you've been introducing, and helping us make fair and balanced presentations, which, by the way, you know, if we go back to that debate, I'll open it up right at the end, right? Did that fair and balanced really help us in compliance? Is this standard going to make our jobs easier or harder to do in the future? There are a lot of examples of what the SEC considers to be fair and balanced throughout the release. I think somebody's going to have to sit down and pull them all out and put them into a spreadsheet, because I feel like the SEC is going to take away our no action letters, and the thing that we're going to have to hang on to are those examples that the SEC has put in front of us here, and that we need to start rebuilding our appreciation of what is fair and balanced off of those examples.
No fair, Keith. You just opened up a whole new can of worms. So
it was a good time at the end of the program, right?
Mike, any sort of recommendations or tips for the audience?
I'm not sure that I could do a better job here than what Keith just did, other than to make a couple much more practical recommendations. Make sure your business knows the size of the lift that this is going to entail and the resources that are going to have to go into it. Ensure that you spend plenty of time training your personnel so that they understand the new rules of the game. And be ready, as Keith indicated, to be making more judgments based on less clear rules, and to get a lot more lobbying, even more than you have now, from the sales and the marketing teams to suggest that something is permitted or should be permitted because it's no longer expressly excluded.
Thanks, Mike. Hey, Megan, if you could take us to the IA member resource slide, please. There we go. So thank you, Keith and Mike, for your outstanding presentation. We really appreciate your insight and being here with us today. I want to remind IA members that we have resources that we continue to develop on our website. We have the marketing implementation group. We have our call coming up in May, and this group is growing every day, and it's an opportunity for members to be able to talk to each other about implementation issues. We got a lot of questions here that we weren't able to get to, so we can raise those questions on these calls. I think Mike's going to join us on the next call, and so he can continue to answer questions. And so please, if you're interested in joining that group, do so. Just contact us. We also have a IA resource library that we're establishing, and there's a lot of good materials on there, including some FAQs and an outline from KNL Gates. We have a forum, an online community discussion forum, and then, as I said, we're going to continue to do these webinars. We're going to continue to address various aspects of the new rule, and so stay tuned for more information on that. Again, Keith, Mike, thank you for being here, for your outstanding presentation. We really appreciate it. And thank you, IA members, for listening in today and being here with us, and for your excellent questions. That's it for me. Thank you, everyone. Enjoy the rest of your day.